Welcome to the last week of this summer class. So today we're going to be covering chapter 13, which is on saving, investment, and the financial system. Okay. So basically, what is the financial system? The financial system is the general umbrella for all financial activities. So think of it as a general umbrella. And then this umbrella consists of what we call financial institutions. And these financial institutions are in charge of linking savers to borrowers, okay? So who are savers? Savers are those who do not consume excessively. So you don't consume all of your income, you save some, you invest some, right? So those are savers. And savers are the reasons why other people who do not save are able to borrow using the money that is saved from the savers. The financial institution links up savers who makes up. So basically, the savers are those who supply the loanable funds in the financial market, okay? So these supply loanable funds, okay? And then the borrowers are those who demand for loanable funds, those who get things on credit, who borrow from the bank, for instance. Those are the borrowers, right? So the financial institutions link up the savers who supply loanable funds to the borrowers who demand for loanable funds. And there are two major financial institutions. We have the financial markets. The financial market is basically things referring to the stock and the bond market, right? So when you talk about stocks and bonds, what is the whole purpose of stocks and bonds? Is to raise money, right? So when you're trying to raise money for like a business or whatever project you're working on, so that is stocks and bonds. So you know, as I'm sure you know, that many companies are in the financial market and have stocks. So a stock is just like the valuation of a company, and if you buy that stock, you get to be one of the shareholders in that company, so that whenever they have profits, they share some of the profit to like those who have stocks, right, in the company. So you earn a profit from getting stocks, you get some taxable income, you earn some interest, right? So stocks is used for what we call equity financing, okay? All right, and then bonds is kind of different. It's also used for financing, but in a different way. It's more like a debt obligation, right? IOU, right? So it's like you are buying bonds, and then in return, you are going to get paid by whosoever you're buying from. So let's say you're buying bonds from the government, right? So you're buying bonds from the government, and then in return, the government pays you like a fixed amount of money, maybe every month or like however periodically you agree, right? So there are different kinds of bonds. So the bond is more like a debt financing, right? So there are different kinds of bonds. There is short-term bonds and long-term bonds. The longer the bonds, the more risky the bonds, because it means that there's a longer probability of not paying back, right, that money that you borrowed. So because of that, longer interest rate bonds have a higher interest rate. Okay, so long-term bonds have a higher interest rate than short-term bonds, and there's also something called private bonds versus government bonds. So private bonds also have a higher interest rate because there's a higher risk of a private company shutting down than the government shutting down. Every nation needs a government to run. So because of that, private bonds, so long-run bonds and private bonds, for instance, also have a higher interest rate due to the high risk. However, the government bonds have a lower interest rate because there's always going to be a government in any nation, so the interest rate is lower due to the lower risk. And then there are different kinds of government bonds. Okay, so there is what we call the municipal bonds. So municipal bonds are bonds that are issued by the state and the local government. So this is by state and local government. And state and the local government is of a lower ranking than the federal government. So because of that, the interest rate on municipal bonds is even lower than the federal bond. So less interest rate, right? So they have less interest rate. And because of how low the interest rate is, this kind of municipal, state and local government bonds do not earn tax, right? So they are not charged tax, right? So no tax for this. Okay. Then the federal government bonds incur taxes because even though it's still safe and relatively lower interest rate, but it's still higher interest rate than the municipal bonds. But how do you account for inflation? So you know that inflation devalues the currency. So if you make an investment, buying stocks and bonds, and then the currency, the value of the currency goes down, how do you protect your investment from losing value in the case of inflation? So that is something called a treasury. I call it TIPS. So that is a treasury inflation protected security, right? So for this kind of tips investment, you are going to be paid interest rates based on a fixed. Remember, we talked about base year, based on real GDP and all of that. So you're going to be paid interest rate based on a base year. So the earnings you're going to be gaining is going to be based on the year in which you made the investment and the value of your investment as at when you did the investment, and not the current value of the currency. There is also something called perpetual bonds, which are bonds that are fixed periodic payments that you make for life, right? So that doesn't have an end date, unlike these other kind of bonds that we've mentioned. So for a savings and investment identity, you remember your calculation of GDP? Your GDP, also known as Y, is equal to your consumption, your investment, your government expenditure, and your net exports. This is for an open economy, right? But for a closed economy that doesn't engage in international trade, your Y is just equal to your C plus I plus G, right? So therefore, your investment is the same thing as saying Y minus C minus G is equal to I, right? And this investment, remember, whatever you invest has to come from your savings. So therefore, your savings is equal to your investment. And this is the same thing as saying it's equal to Y, which is national income minus consumption minus tax. This is known as private savings. Plus your T, so in this case, your T is going to be your tax revenue minus your government expenditure, right? So in this case, when earnings of the government exceeds the expenses, then that is known as a budget surplus, right? So if this is greater than this, then that is a budget surplus. However, if the government expenses exceeds the revenue, then that is known as a budget deficit, right? And total government revenue minus the government expenses gives you your public savings. So the addition of your private savings as individuals and the public savings from the government adds up to your national savings. So that is that about savings and investment identity. And something else to note is that remember your deficit and your surplus. So this is your demand curve and this is your supply curve, and you know this is your equilibrium point. Now when your interest rate is below the equilibrium, right? So this is your equilibrium, and let's assume your interest rate is here, right? Below the equilibrium. Can you see where it stretches all the way to? It stretches all the way to your demand curve, which means that your demand for investments is going to exceed your supply. So remember, who are the people that demand for investments? Those are the borrowers. Those who don't save up enough are those who end up borrowing and demanding for money, right? So they're the ones who go to the bank to get a loan, or you go to a loan app, right, to get a loan for fintech's help. So in this case, so that is when you have your demand. So you have too many people that are demanding for loanable funds because they don't save up enough. So those are the borrowers, and they make up the demand for loanable funds, right? So when you have too many people demanding that exceed your supply, so whenever there's too much demand, then that leads to scarcity, and whenever there's scarcity, that leads to an increase in price, right? So eventually interest rate is going to go up, and that is because this is because at this point your demand exceeds your supply, and then that pushes your interest rate up, right? So this is equivalent to when there's a government deficit. So government deficit, we talked about government deficit here, but basically when the public sector borrowing, that means the government is borrowing way too much in the market, right, or in the financial system, that crowds out the private sector, and that leads to scarcity, right? So this is a scenario of government deficit or crowding out. Okay, and the complete opposite of that is when your interest rate is above the equilibrium, right? So when your interest rate is above the equilibrium, that's going to be the complete opposite. That is going to make your supply of loanable funds to exceed your demand. When there is surplus of something, so this is going to cause a surplus, right? So this causes a deficit, right? And this causes a surplus. So when there's surplus of something, that eventually is going to make the interest rates go down, right? Which is the price. So this eventually leads to lower interest rate. So notice that this second scenario where your interest rate is above your equilibrium, this is what we call savings policies, right? So this is a savings policy. Because your interest rate goes low, because of the surplus of loanable funds, interest rate goes low, then that encourages investments. Because if the interest rate is low, think about it, you will want to borrow more money because you have to pay back less amount, right? Because the interest rate is low. So that encourages your investment. And that is an investment related policy, right? And this is also due to the abundance of fintech and financial technology hubs that we have. So it's very easy for you to go download an app and borrow money online. So like the cost of borrowing is very cheap, right? So that is this kind of scenario where interest rate is quite low. And that is that on chapter 13. So now that we've learned a little bit about financial systems, and how that involves both financial markets and intermediaries, we've learned about savings and investment and how that affects the interest rate. Now it's time to move on to chapter 14, which is briefly about the basic tools of finance. So first things first, we talked about interest rate earlier on, but when let's say you go to a bank to deposit money because you want to save your money, right? You're going to earn interest rate on that deposit, right? But that interest rate is going to be accumulated over time, right? So let's say you want to leave that money in the bank for several years, right? So the interest rate is going to compound and accumulate over time. So you're going to end up earning more at the end of an extended period of time. And that is what we call a compound interest rate. So that leads us to the concept of present value and future value. Present value is saying in 2035, an amount of $20,000 is worth how much right now. So that is present value. So you're trying to discount from the future to the present. It's usually very useful when you're trying to make an investment and then you're like, okay, in the next 10 years, this investment is going to be worth this amount of money. So based on that future value of the money, then how much is it going to be worth right now? Is it worth investing in right now based on your estimated projection of its worth in the future, right? So that is called present value when you have to discount. So this is how you calculate your present value. So it's your principal divided by 1 plus your R. So your R is your interest rates raised to power n. N is your number of years. Okay, so number of years. So this is how you calculate present value, and that just means you are discounting your interest rates. So you are discounting a future value into the present. Okay, and it helps in making investment decisions. Okay, how about the future value? The future value is the opposite, right? The future value is your principal multiplied by 1 plus your interest rate raised to power n. So basically, what is a future value? Future value is, for instance, you are making a savings, right? A savings in the account, and you want to know, okay, I'm depositing $100 into the account right now. What is it going to be worth in the future, right? In the next 10 years, how much is $100 going to be, right? So let's take an example, right? So again, this example of $100, right? So let's assume we have $100 we're depositing in a bank to save, and let's assume that the interest rate that the bank is charging is 3%, right? So 3%, and let's assume we want to know how much it's going to be in the next 5 years. So basically, by the time you do your calculation, this is going to come up to $115.93, right? So this is at this interest rate. Now let's compare. How we got interest rate? This is 3%. So 3% divided by 100, that's how we got this, right? So how about if we have an interest rate versus an interest rate of 7%, right? 7%, 7 divided by 100, that's going to give you, right, this, right? And then in the same duration, what does that give you? That gives you a value of about 140.2, right, 0.26. So therefore, you can see that having a higher interest rate is better for savings, right? So in terms of savings and trying to get the future value of the current money, it's actually better to have a higher interest rate, right? So higher interest rate is better for the future value, especially when it comes to savings. How about for the present value? So let's say you're trying to make a decision. You want to buy a plot of land, and that plot of land is valued at $120,000 in the next 10 years, right? And they are selling that plot of land right now for $70,000. So in that case, you have to discount the value of $120,000 in 10 years and try to see how much it's going to be worth right now. Is it actually worth it to buy that land for $70,000? So let's quickly do that, right? So you have $120,000, which is in principal, and let's assume again the interest rate is 3%, so 0.033 divided by 100 in the next 10 years, right? This is going to give you about $89,000 and $291, roughly about this amount, right? So let's keep this money on one side. How about if we use an interest rate of 7%, right? Divided by 1.007 raised to the power 10, that is going to give an even lower value of 61,000, roughly 61,000, okay? Now, can you see how with 3% interest rate, the value of $120,000 for the future comes down to $89,000? And the value of the land, remember that the value of the land is how much? $70,000. So that means this has a greater value right now, right? So if something is worth $89,000 and you're actually getting the plot of land for $70,000 now, that's a pretty good investment, right? So therefore, you should buy the land, right? Okay, but at this other choice of $61,000, if the plot of land, the current value of the plot of land is $61,000, then why are you buying it for $70,000? That's the wrong decision, okay? So this is how you use present value to make investment decisions, and future value gives you an idea of savings, right? In terms of saving for the long term. So that is a very important concept in chapter 14. The next one I want to talk about quickly is risk. So every investment involves taking risk, and there are three kinds of people when it comes to risk. So there is your risk lover. So your risk lover, as the name implies, they love taking risk. So you're going to have your utility on this side. So what does utility mean? Utility means satisfaction, and then you're going to have your wealth. In other words, your income, your wealth on this x-axis, right? Okay. So now, for a risk lover, they love taking risks. So the higher the money involved, the more they are to take a gamble, okay? The more they are to invest. So this is how the curve is going to look. It's an upward sloping curve, okay? So this is for a risk lover. How about a risk neutral person? A risk neutral person is indifferent between taking a risk or not. They really don't care, right? Okay. So for a risk neutral person, the curve is going to be a straight line, okay? So this is going to be a straight line for a risk neutral person. How about a risk averse person? So most people in life tend to be risk averse, meaning that they don't want to take risks. So if it's a risk that involves just $5, $10, they can gamble, they can party with $5, $10, they don't mind it. But the higher the amounts involved, like when you're talking about $10,000, $1 million, people are less likely to take risks with such a huge sum of money, right? So those are risk averse people, and you guessed it right. So remember, at lower amounts of wealth, they are willing to take take a little bit of risk and get some satisfaction, right? So you see that it slopes upward first, and then they reach a point where it's like, hey, this is my limit. I can no longer take risks because the money involved is getting too much, and then it reaches a point where it starts sloping downwards, right? So in other words, when the money is too much, they are not interested in taking the risk, right? So these are risk averse people, okay? And that is that about risk lovers. I'm not going to ask too many questions on chapter 14, so you should be good. Hi class, so welcome to chapter 15. This is one of the last chapters we're going to cover. Congratulations on making it through so far from the beginning of this class, this course to the end. We have made so much progress, and I'm so proud of you for pushing forward and persevering. I'm going to have a couple of extra points available, and it's going to be based off on concepts in subsequent chapters like chapter 16 and the likes, but it's completely optional. If you want to earn extra points, you're free to post your answers in form of a discussion on Canvas, right? So don't forget, if you have any questions, feel free to reach out to me, and I hope you've been finding everything really helpful. I'm sure you've learned a lot. I've really enjoyed teaching you so far. Okay, so what is unemployment? Unemployment is, first of all, it refers to the adult population. Emphasis on adult population. It doesn't capture people below 16 years. You have to be 16 years and above to even be employed or considered unemployed, right? So unemployment is the adult population of people who are willing to work, but are unable to find a job within the last 4 weeks, okay? So if you're only looking for a job for 1 week, you don't count as unemployed. If you're looking for a job for 3 weeks and 6 days, that's not unemployed. It has to be 4 weeks or more, right? And it has to be that you're willing and able. So if you're looking for a job but you're not able to work, or you're not able to, maybe have a disability or whatever, then that doesn't count as unemployed. You have to be able, willing, but unable to find a job. And that is unemployed. So basically, as I already mentioned, you have to be able and willing, and those who are able and willing are those who are in the labor force, okay? So the labor force consists of employed and unemployed people. So who are those in the labor force? The labor force are those aged 16 to 65 years. Again, depending on the retirement age, but let's assume retirement age is 65 years. So like 16 to 65 years are those who are in the labor force, meaning that they're able, right, and willing to work, okay? And those employed, of course. So employment includes full-time workers, part-time workers, self-employed workers, okay? So if you're a business person, you're also employed, right? So these are all categories of employment. How about unemployed? Unemployed people are, again, those who can find a job within greater than, so above or at least 4 weeks, right? Okay, so if you switch from a part-time work to a full-time work, the unemployment rate doesn't change because either full-time, part-time, or self-time is employed. So switching among these types of unemployment doesn't change the unemployment rate. So how do we even calculate unemployment rate? So unemployment rate is calculated as the number of employed people divided by the labor force times 100. Okay, so it's like saying how many people out of the labor force actually have a job. That is employment rate. Same concept, unemployment rates are how many people out of the labor force do not have a job, right? So that would be the number of unemployed people divided by the labor force. I'm just going to say labor force, LAB, times 100. Okay, so times 100. So it's a rate. So because it's unemployment rate, that's why you multiply by 100. Okay, employment rate, you also multiply by 100. How about labor force rates? So I'm going to call it, labor force rate is just the number of people in the labor force, right? So in other words, the number of employed plus unemployed divided by the number of adult population. So remember adult population. This adult population includes people that are employed, people that are unemployed, and people who are out of the labor force, right? So adult population includes labor force plus not in labor force. Okay, and who are those that are not in the labor force? Those who are retired, for example. If you are retired, you're no longer in the labor force, so you're part of the adult population, but you're not part of the labor force. If you are less than 16 years old, it's considered child labor for anyone less than that to work, less than that age to work. So that would also be not in the labor force. People who choose not to work, so they're household givers, like parents, right? So let's say like a mom who chooses, okay, I don't want to work, I want to take care of my kids, I want to be a full-time housewife, right, or a full-time house dad. So that those are not in the labor force because they choose not to work. Okay. So let's take a quick calculation. So let's assume the number of employed people are 158.3 million. The number of unemployed people are 5.7 million. And then the number of those not in the labor force are 100.1 million. So now let us calculate the employment rate. Your employment rate is simply going to be 158.3 divided by labor force. How do you know those who are in the labor force? The addition of your employment plus your unemployment gives you those who are in the labor force. And that is going to give you 164. So you have a total of 164 people that are in the labor force. So 158.3 divided by 164 million times 100. That is going to give you an employment rate of about 90%. Okay, so that's going to give you an employment rate of about 90% plus. Okay, how about unemployment? So unemployment rate is going to be 5.7 million divided by 164 million times 100. And that is going to give you an unemployment rate of 3.5%. Okay, so this adds up to give you your labor force. How about your labor force participation rate? So labor force participation rate is saying how many people out of the adult population are participating in the labor force, okay? So that is simply going to be the number of your labor force. So when we talked about this, then right here. So how many people do you have in your labor force? 164 million. How many people do you have in your adult population? Those in the labor force of 164 million plus those not in the labor force of 100.1 million. So this total gives you 264.1 as the adult population, right? So 164 divided by 264.1 times 100. That is going to give you a labor force participation rate of 62.1%. So this, in a nutshell, is how you calculate unemployment rate. Now, there are different kinds of unemployment. So there is something called seasonal unemployment, which, as you can infer, is unemployment based on season. So there are periods where you are likely, like a fisherman, for instance, is most likely going to get more fish and have, more catches when it's rainy season, right? Even construction workers prefer to work, during the dry season, so like more like summer or even spring. But yeah, you wouldn't see construction workers actively working during the winter because it's very cold and the weather conditions are not fit for that, right? So that's an example of seasonal employment. So it's based on the kind of job that you're doing. Yeah. And another type of unemployment is something called cyclical unemployment. Cyclical unemployment is simply the unemployment that occurs based on the business cycles. So there are different kinds of business cycles. There are 4 actually. So there is an expansion phase. An expansion phase is when the economy is, doing pretty good, things are progressing, things are going up, productivity is increasing, everybody's doing good. So basically the economy is, booming, right? So this is an expansion phase. That's an EXP, expansion. Now, there's the peak. So the peak is the highest point of productivity, right? And then there's what we call a recession. So a recession is when economic activities are dwindling. So economic activities are going down, things are not looking so good, people are making less money, all of that, generally. So that is a recession. And then there's what we call the lowest point, which is a trough. This lowest point is like a depression. So you're at the lowest point of economic activity. Nothing is, moving. Everything is like stagnant at the lowest point, right? So these are the different economic cycles. And basically, every country has these cycles fluctuating over time, right? So it keeps going up and down, right? It's never fixed at one stage for a long period of time. It fluctuates over time, right? So even if you look at the stock market, things are always fluctuating, right? Things are always going up and down, right? So that is what we call business cycle. So if an economy is at the expansion phase, then definitely unemployment is going to be low because, everything is booming, things are doing well. So that is going to be low unemployment, right? So this has low unemployment. I'm just gonna use my arrow, low unemployment, right? But this recession phase has high unemployment. So things are not looking good in the economy, right? So unemployment increases. So cyclical unemployment is due to economic cycles, especially recession, right? So when there's a downturn in economic activities, right? So that's one kind of unemployment. And something else to note is that your cyclical unemployment is fluctuating over a stable trend, right? So for instance, you see that across this fluctuation, you could draw a line that passes through right here in the middle, right? So this trend is what we call, this constant trend that you can see over time is what we call natural unemployment. So natural unemployment is that stable long-run trend. So basically, it's like there will always be people in any country who decide to be unemployed. Either they want to be like a housewife or a house dad or whatever it is, or they just decide, okay, I've worked too much, I just need 1 year of break or whatever, right? So these are natural unemployment people because they choose to be unemployed, right? So in any country, you cannot have the entire labor force working at the same time. Like, there will always be people who will be unemployed, okay? And that is the natural unemployment, which is this long run trend, okay? So now how about frictional unemployment? Frictional unemployment is, that duration between when you're switching jobs or that duration between when you're looking for the next job. So let's say, leave one job and you're trying to find another job, right? Let's say because of your family, you're trying to relocate and find another job that matches your family and preferences, right? So that period of job search is what we call frictional unemployment, because it takes a while between when you submit your application for a job and when you get a response for like an interview. When you do the interview, it probably goes through several stages of interview and all of that before you get accepted or rejected, right? So most times you get some rejections before you get some acceptances, right? So that whole process of waiting and looking for the next job is what we call a frictional unemployment. And so it's due to job search and the time to match workers. So the whole reason why it's taking time is, as a worker, you are looking for like a certain pay. So let's say you do the interview and the pay they're offering is not what you want, right? So then you decline the job offer and you look for another one, right? So that time it takes to match workers and employers, right, is what we call frictional unemployment. And what does government do? So government tries to help in different ways. So as you know, there are like several websites online that makes the process easier for you to like look online and see what job postings are available, and then you can easily apply in one sitting, right? So like all those online job applications, or even like training programs. So that there are some online or like government training programs that help you to get the skills required, right, to apply for jobs. So all of these are ways that government intervenes. Another way that the government can intervene, since frictional unemployment is more short run, right? So most times unemployment don't last forever, right? So you're just looking for a job, maybe like a couple of months on average, right? But frictional unemployment is mostly short run. So it's not for too long. And because of that, the government can also help with giving incentives like unemployment insurance, right? So the government also helps with unemployment insurance. What is unemployment insurance? Do you remember during COVID, when most of us couldn't go to work as usual, and so the government stepped in by giving financial stimulus checks, right? So giving checks to help people take care of their day-to-day expenses so that they don't have to suffer as much, right? So that is an example of unemployment insurance, right? So that helps to, make things, it cushions the effect, makes things easier for people, it reduces uncertainty. However, I remember we talked about this at the beginning in the first few chapters, that eventually it could discourage people from wanting to work, right? Because if they're getting checks from the government for being unemployed, then some people would just rather not work and just keep on getting the checks, right? right? So ultimately, government intervention is inefficient, right? As much as government intervenes with a good mindset, but it usually causes inefficiency and distorts the market. Okay, so that is that about frictional unemployment. How about structural unemployment? Structural unemployment is due to shifts, right? Including technological changes. So, for instance, when like we have AI now and we have more robots now, as opposed to like a decade ago or even like the 19th century. So, all of these technological shifts put workers at risk, right, in terms of losing their jobs to technology or AI or all of that stuff. So that is called a structural unemployment. So it's due to technological changes or demographic changes. Okay, and this is more long term. So because, for instance, when a technology comes into a trend, it's not just going to go out like that, right? That technology is most likely going to stay and keep on evolving into greater, better versions that keep on putting the working population at risk of losing their jobs, right? Or vice versa, whatever the demographic changes are, right? But most likely when such changes occur, it just keeps on evolving, and this reflects something we call. This is similar to, remember your price floor and your price ceiling. This is similar to when there is a binding price floor. Okay, so remember you have your equilibrium here. So when there's a binding price floor, remember you can pay only above a particular legal minimum price. So because of that, it's going to be above the equilibrium. So remember your binding price floor, right? And also remember that this is due to sticky wages. So remember, whenever the price of something goes up, or rather sticky prices, whenever the price of something goes up, it's very hard to come down, right? So because of that, these are the kind of things that lead to excess supply, right? So remember, this is your supply curve. And in the job market, we individuals, we households supply our labor, and then the firms demand for us, right? So whenever there's higher than equilibrium price, it leads to what we call surplus, right? So labor surplus, which causes unemployment. Another example of this binding price floor is something we call efficiency wages. So efficiency wages are when companies want to encourage workers to be more productive and all of that. So they set wages higher than the equilibrium. And what that means is that they would have to let go of unskilled workers, right? People that don't have as much experience. Because think of it, if you're a business person and you have to pay a very high wage, then you would rather let go of the unskilled workers and keep the very skilled workers to be the most efficient and move the firm forward, right? So that is how it works. So people like teenagers, high school graduates who haven't completed college are at a disadvantage because they don't have too many years of experience. So that's another way binding price floor works in terms of efficiency wages. And how about labor unions? So labor unions is something else. So remember, labor unions always advocate for higher wages, right? So whenever you have higher than equilibrium wages, it's due to these factors. And of course, your minimum wage. That's the whole point of higher than efficiency, higher than equilibrium prices.